Hey everybody, welcome to Wine and Real Estate. So we're live. Bonsoir tout le monde. Bienvenue sur Vin Immobilier. Tonight we're really excited to have a special guest on, Dalia Barsoum from Streetwise Mortgages. And Dalia and her team have been a key part of our team, our power team, for the past
helping us build our portfolio for over a year now.
Yeah, it's crazy. In over a year, we were going through our income tax and all the files, and like Streetwise, refinance,
there's
purchase,
been a few.
sell. So yeah, there's been a few, and many more to come. So that's good.
Yes.
Thank you for coming on.
Yes.
Oh, my pleasure. Thank you very much for this opportunity, and I am honored to be part of your team and support your growth and success. Learned personally a lot from you guys as well.
Oh, you learned from us. Cool. That's interesting.
Yeah,
we always learn from our investors because, there is always something with deal structure, type of property, strategy. So it's fascinating just to be in the center of the deal and to see everything else. So
yeah,
we always do learn.
Well, financing is always so central to the deal, right?
Yeah, exactly. And that's the reason I picked financing to start. So.
Okay, so just introduce yourself to everybody. Tell us a little bit about yourself, your background, and why you started out Streetwise Mortgages.
Yeah, sure. Well, I'm Dalia, and I'm the principal broker of Streetwise Mortgages. We're a boutique mortgage brokerage based in Ontario. But we service real estate investors. We're based in Woodbridge, but we service real estate investors across Ontario. And we specialize in portfolio financing. So a lot of the clients we work with are clients who are looking to build a portfolio and acquire multiple properties to supplement income or retire or a combination of both. And I've been a broker now for 10 years. This is our 10-year anniversary in November.
Wow, congrats.
Yeah, thank you. And I basically came from a banking environment. I worked with the banks for about 12 years and in the financial industry for about 20 years. And I, was just classic working for the bank. Started really as right out of school, worked as a computer programmer when I first started. My background is computer science and accounting. So I started as a programmer in systems. And then got sick and tired of talking to computers and no people. It was brilliant work, like fun work to work in IT at the time, but just not having that human interaction was just bothering me. So I gradually started to shift from technology to business and moved to gradually to the business side, and then did my master's degree in finance and shifted gears completely to business. So, spent some time in lending, strategy, wealth management, and then moved on to the brokerage because I wanted to have a little bit more control over my time. At the time, I had little kids. For those who have kids, they could probably relate to what I'm talking about. Kids get sick. Kids need, schedule changes. So I basically left because I wanted control over my time. And also I had a passion for real estate. And I found that financing would give me that opportunity to be at the center of the deal and also leverage off my past experience at the bank. So that's how it all started.
Amazing. Wow.
It's so well-rounded. Like, what a great experience to bring to the table now as a broker.
Yes, the experience that I got at the banks served me so well. It was really like amazing. Everything that I've learned, I'm bringing to the business and to clients. So absolutely.
Did you ever work at Scotia? I have to ask.
No.
Oh my!
I have not worked at Scotiabank.
Okay, because I know that's one top product. I mean, because of what they offer, but I was curious to know if you worked there.
No, I never worked. Yeah, no, guys, I like going to Scotiabank for rental products for a reason. It is because of many reasons we can talk about later, but I worked primarily for BMO.
Okay. Yeah, we love BMO for the all the accounts like this, all the sub accounts.
Our corporate accounts and sub accounts. It's a great product as well. We've never had a mortgage with them before.
No, they're not interested in lending to us, I guess. But anyway, they have our money.
Every bank is different.
Yes.
Yeah, that's it.
That's so true.
Yeah.
So we're wine and real estate. We're drinking tonight at Shiraz Cabernet. What are you drinking tonight?
I'm drinking a Shiraz.
Oh, nice.
Yes.
Good taste.
One of Francois' favorites.
Oh, is it? I love Shiraz. I love how deep the flavor is.
Yeah, the richness.
Yes, it's very good.
Any specific country or any Shiraz will do? Because sometimes it's Australian or it's a bit different. So
any Shiraz, I'm into any Shiraz. I drink more Australian Shiraz, but any Shiraz would do.
Okay.
Oh, good. Well, you guys are on the same team.
Yes. Yeah, I love Shiraz.
I like Shiraz as well, but it's not like my favorite one, but I still like it a lot as well.
And the French one's La Syrah, so it's a little bit different. I don't like it as much. I guess maybe it's the hotter climate, like Australia. It's got a little deeper flavor, in my opinion, anyway. But
well, I know that the Shiraz grape is a grape that is flexible to climate, and it turns out to different flavors depending on where it grows.
You really taste it. Like if you have a French versus Australian, or where else does it grow? I'm trying to remember now. In the States, I think. Yeah. California.
They do have it in California as well. Yeah.
Yeah, and it doesn't taste quite the same. I guess the soil as well.
Yeah. Yeah.
Cool.
Anyway, interesting. So tell us about your real estate journey. I mean, obviously you're helping tons of real estate investors. Do you invest yourself? What made you kind of go towards that kind of niche?
So I'm an investor myself, and I hold a portfolio of properties in Barrie and in Vaughan.
Nice.
I got into Vaughan really early on, before Vaughan Mills was built and before the
just at the right time.
Like, you look at it and you go, oh, this was a smart decision. I had no idea what I was doing at the time. Okay, you know what, let's just buy in this area, the prices make sense, and maybe this is gonna happen. And anyway, so I do have some townhouses in Vaughan, but my really cash cow properties are in Barrie. The duplexes, the duplexes with the third units, the garden suites. So that's primarily my portfolio, buy and hold long term, and I supplement with private lending as well as part of the mix. So
yes.
Oh, that's great.
Yeah, and I started in 2008. I started while I was working for the bank, because at the time I was in wealth management. And I saw the market decline of
2008. Oh my goodness. Yes, they went.
At the time I was invested in mutual funds. I didn't have rental properties. We had our primary residence, but we saw our money evaporate technically in the 2008 crash. And I felt that we felt that we had no control other than, let's just wait and see what happens. There was no control. And that was a turning point for us in terms of saying, you know what, there must be a better way of doing this. And this is where I started to dig into real estate, eat books wherever I can, attend every, event, every seminar, talk to people. And that's when we started with our first property in Barrie. We still hold it.
Oh, wow.
Yeah, we still hold it. It's in Southwest Barrie. And it was a townhouse.
Okay. I must have appreciated like crazy.
Yes, Barrie has gone up significantly.
Absolutely. If we were to go buy the same house today, it wouldn't cash flow. But because so many years ago, like the cash flow is still strong.
Wow, that's amazing.
That's awesome.
Yeah.
And that's so smart. Those are two really great markets, because Vaughan Mills, like if you bought before Vaughan Mills was there, it was basically Canada's Wonderland that was there. And that was it.
I remember going there was in fields of corn and then Canada's Wonderland. And now it's
absolutely. Exactly. It was all farmland with Canada's Wonderland. And at the time, there were several builders around this Canada Wonderland area that are, building that area. So we actually purchased in Vaughan our primary residence at the time.
Really? Wow.
We ended up buying, the townhouses after that.
Oh, wow. Well, that's so smart because it's unbelievable. Like, I think condos are going for like 500,000 in Vaughan right now.
Oh, no, more.
Yeah, around, like they start at 500.
Yeah.
Yeah.
They started 500,000, which is unbelievable. We actually know someone who bought one and I was like,
She
really?
showed us.
It looks like you bought a shoebox for 500,000.
Yes.
Yeah.
I couldn't believe it, but it's crazy. And there's nonstop building in Vaughan, and I'm sure it's the same in Barrie as well. Like, it's just unbelievable. And there's even commuters coming from Barrie working in Toronto.
Yeah.
Yeah, because see, now with Vaughan, there is the subway station is at 7 and Jane. And there is also the GO train at Rutherford. So there is connectivity now up to Vaughan. And yes, there are people that come to Vaughan, go to downtown, or take the GO train from Barrie straight to downtown. So it's all now connected.
I love it. You thought you didn't know what you were doing back then.
I didn't know what I was doing back then. At the time I was just starting out. I was following some research that said, here are the areas to consider, but it made common sense, right? Like, we know there is eventually a subway coming. We know that there is eventually a mall coming, and it was central location. Like, you've got the 400, you've got the 407. It's half an hour from Toronto, half an hour from Mississauga. Like that, it was a hub.
It's bound to be go up.
Yeah. So and then the green belt, they were building all of the construction was going up. So we saw signs and we just ended up buying based on that, and turned out an amazing decision.
Yes, that's awesome. That's a great real estate story, because sometimes people, I think that they're over analyzing things too much, and sometimes you just have to be an action taker. So you were totally an action taker there.
But now we're spoiled because you publish amazing research on different markets. So I've watched your YouTube videos and your series, and it's really like you got all kinds of background information now. I'm sure in 2008, it wasn't as easy to find.
No.
Now it's super spoiled. You just tune in and you get all the information.
Yeah, no, it was very different in 2008. I mean, the Vaughan decision it appears to have been obvious to us, but investing in Barrie was analysis paralysis. Like, Barrie was a completely different story. Analysis paralysis, it took us a while to get into Barrie. And it's honestly the one decision I regret, that we should have started earlier in real estate.
Yeah, that's everybody.
When you're starting out, you're going through all of these numbers, and you gotta just make a move. If the deal makes sense, you just make a move. It's a hard asset. Surround yourself with the right people and move. That's it.
Yeah, that's
we
really
really
good
believe
advice.
in that now.
Yes.
So tell us, you're working a lot with investors, like you said. How do you help an investor kind of build a strategy? What's kind of the ABC to that?
So one of the things that are crucial when it comes to building an investment portfolio is really to think ahead of time about what we call your financing roadmap. When you're buying your primary residence, it's not complicated. Primary residence, you've got your income, your credit, your down payment, and you've got a good property. You're going to live in a good property. It's not going to be run down. Like, all of the pillars are solid, straightforward formula, no complications. You can go to a bank if you want. But when it comes to income properties, it's a completely different story. There are multiple ways the lenders look at income properties. They use the rental income in different ways. There are areas they lend in. There are areas they don't lend in. And then layer on top of that, the strategies investors use: student rental, rent to own, multi-residential, buy, renovate, refinance, rent, flip the property, assignments. It's like, you've got the base, and then you got all of these variations on top.
Yeah.
So the complexity is different. And then on top of that, now you have an investor who wants to keep going with their portfolio and trying to think ahead of time, okay, where is my money going to come from? How am I going to structure the deals? If I'm going to use that certain strategy, what does that mean? So all of these things have to be taken into consideration to actually arrange financing. And we have to think ahead of time about what is the implication of making a decision today on your future plans. You can't make this decision in silo and say, okay, you know, I got my mortgage. When my next deal comes, I'll figure it out. You can't. So simple things like someone taking a 25-year amortization mortgage on a deal today and getting a great rate, on the surface, that sounds fine.
Yeah, but that can be poison.
You guys know probably, but in reality, your cash flow is smaller because your payment is higher. Now it eats into your next deal and the following one and the following one. Simple thing, one little detail. So where we help investors is we help investors strategize and basically think about the financing roadmap for the next set of deals. So whatever we're doing today is well planned, and we know that it's not going to hit us down the road. But also, our philosophy is to iron out as much as we can early in the process. This way, there are no surprises, because it is beyond what you qualify for. Qualification is just
one element.
It's really, qualification is the tip of the iceberg. But when the rubber hits the road, it's where is your down payment coming from? How is it going to show up in your account? Who's going to be on the deals? How are we going to structure them? Do we have JV partners? Do we have multiple people? Is it a corporation? Is it your personal name? How many properties are we dealing with? Like, there is so much more that we have to deal with upfront. So later on, you're just implementing. And that's where we help investors.
Yes.
Yeah, and you have some amazing programs. Like I mentioned Scotia earlier, but there's some crazy offers with the STEP program, things like that. So for people that are starting out, it's quite exciting.
Mm-hmm.
And I also learned kind of the hard way. Some banks seem to take more space in your credit. So depending on the lender, some have more weight, it seems. So it kind of blocks off. And that goes back to your planning, because you're like, oh, that's what we did at first. Let's buy one and figure it out. And let's buy two. And oh, okay, this is what happens.
Because it seems like with every deal, and I don't know if you can confirm this or not, but with every deal, it gets a little bit more complicated.
Yeah. They want to know more.
Like, okay, now we're at 4. Now we're at 5. Okay, how are we going to do 6?
Now we have JVs. Now we have a corporation. Now we have, it just goes up and up and up. And now we want to do commercials. So again, that's a whole new ballgame.
Yeah. So would you like to explain to people who are listening, what's the difference between residential? Sorry, I think I had too much wine. And commercial mortgages. I'm going to have some more.
Yes, have a sip before you say
yes.
Commercial versus residential. I know there's like some huge differences, but there are some similarities.
Just break it down briefly for people who are listening who might not know the difference.
Yes, absolutely. So here are the key differences, okay? The first key difference is when you're buying a residential property, so single family, duplex, triplex, fourplex, generally speaking, or most of the time, let me put it this way, most of the time, 99.9% of the time, the approval is based on your personal income and your personal debts. And yes, the lenders are going to take the rental income into consideration, but they look at your ability personally to service the mortgage. Yeah. When you're dealing with commercial financing, so 5 units and above, or what's called commercial underwriting, the lenders look at the property as if it's the applicant, and they look at the income and expense of the property, and they say, okay, how much mortgage can this property service based on its income and expense? They still want to know about you as a borrower, because they want to know, right, and you're still going to personally guarantee the loan. There is misconception that if you do commercial financing, it's the property and you have nothing to do with it. But
no, there's still a name. Someone has to sign somewhere.
Exactly, and personal guarantees, right? But these are the two key differences. So we've done commercial deals for clients who personally have zero income, because it's a property that is applying for the mortgage. And the other misconception on the market is that if you have a duplex or a triplex or a fourplex, like a residential property, some clients think that it's residential financing, but not really. Most of the lenders will do it as residential, but there is actually a way to look at it in a commercial way if we want to.
Yeah, if the value, I guess, is 500,000 or up, or $1 million, or maybe depending on the market, I assume. Or
well, in Toronto, everything's more than
yeah.
500,000.
Yeah, it's really here is the thing. For smaller property guys, you definitely want to do it residential because you get your 30-year amortization, you get an 80% loan to value if you qualify, and your costs are lower. Appraisal is cheaper. There are no fees. Okay, but if there is absolutely no way to do a duplex or a triplex or a fourplex residentially, we would go commercial. But then something has to give. What do you give away? You give away amortization. It's 25 years versus the 30 years. You may give away loan to value and cut it down to 70 or 75%, depending on the property. And of course, you have to factor some higher costs because your appraisal is more expensive. The lenders charge a fee, the brokers charge a fee. So commercial is always an option, but it's a last resort for smaller properties. It's a beautiful option for 5 units and above.
Yes.
Okay. So it's kind of like you always want to use all of your residential options before going to commercial.
Yes. Yeah. Exactly, Jennifer. That's the case.
And there's CMHC in commercial, but that's very, very long. You can have a baby before you're done.
You would have a baby, and your baby would have gone to university.
Yes.
Sorry if there is any CMHC audience on this call, guys. Come on, the approval alone takes 90 days.
Yeah, but I heard a good reason why, and the whole purpose of CMHC is to help Canadians own housing at a reasonable price. So investors, it's not their priority, and it makes sense. I mean, it's not the goal of CMHC. I think is to provide like everybody a house and help them get a house.
Yes, exactly, Francois. On the commercial side, though, their rates are amazing. Like right now, on an apartment. Okay, listen to this. Apartment building, you can get a CMHC rate at anywhere from 1.7, 1.8.
That's almost free. Wow. They almost pay you to buy it.
Yeah, and your amortization can go up to
40, 50?
40 years.
40, wow.
If the building economic life is longer than the requested amortization, then they would give you that amortization. So 30, 35, and 40 years.
That's something, we learned the economic life is a new concept because in a house, you don't really think about it much. But commercial, I mean, everything does wear out and there's standards and sprinklers and all kinds of things to consider. So economic life is very different.
Yeah.
But a 90-day wait for your approval, that's a long time.
Can be,
In the real estate investment world, it's a long time.
That's off market. You can't have on market because then, you're out. You need to buy cash and then go back and finance it or find private lending. That's something you mentioned earlier. You finance it privately if you're like stressed for time, and then I guess you circle back and refinance. Or
is that a strategy that's possible?
Yes, so you either finance it privately or conventional financing. Okay, conventional financing is faster. Conventional financing is maximum 75%, 25-year AM. The rates are around anywhere from 2.8 to 3. The turnaround time is much faster. Like we funded conventional deals in 6 weeks end to end versus waiting on an approval for 3 months. That's his approval alone. So one option is to pick it up conventional and then refinance with CMHC later, and then time is on your side. Or we go private and refinance. Mind you, in May, CMHC changed the guidelines. And if you were to refinance a private loan using a CMHC loan, that lender needs to be approved on CMHC's list. They don't.
So it can't just be.
Not anymore. Not anymore. Not anymore.
Yeah.
Okay.
Yeah. So if we know that's the strategy, we have to plan for it ahead of time and make sure that we line up the right lender on acquisition. So when you refinance, it's not a hassle.
Oh, okay. That's interesting. And it's good to know for people who are listening as well.
Because that's something I'm like, well, we could round up enough people and buy it cash, but then, yeah, it's not CMHC approved because they're not an institution. They're just individuals with some money. So.
Cash is different. Cash is not a private mortgage, right?
Oh, no, okay.
No,
so if someone put cash and then you sign a promissory note or whatever, then it's not the same.
I don't think you should say that.
Let's drink the wine. No, it's when you have people coming together to buy buildings, and we've done that before. Okay, you can have a corporation and you can have shareholders who are bringing money to the deal. We've done that before. That's like a cash purchase. That's different from you securing a first mortgage through a private lender.
Yeah, going like registered funds for $1 million or whatever. Then
exactly.
Okay.
Yeah, exactly.
It's your own money that's in it. It's not.
Well,
not
no, it could be
borrowing
investors' money, but it's
They're
their
in the
money
deal.
because they're in the deal.
Yes.
Yeah.
I think you had too much wine.
Yeah,
too.
that's it. You asked all the questions and I keep drinking the wine.
Yeah,
so.
exactly. So, what do you advise people who are starting out investing? Like we had talked about it a little bit, but what would you say are the top 3 things that people should think about when they're investing and kind of working with their broker?
So there are 3 things that I would highlight. One, as an investor, you really want to validate your assumptions with your broker. So I talk to a client and the client says, okay, I'm going to buy this property. I'm going to renovate it for this much. And I'm going to refinance it to a bank. And I'm going to be able to take out this much at this rate. And this is my strategy. And I say, okay, what assumptions have you used?
Yeah, too many podcasts.
What did you say? Sorry, I didn't hear you.
Too many podcasts.
Yes. Yeah. So assumptions kill deals. Assumptions kill deals because as an investor, you don't know all of the rules behind the scenes. So you got to really take your story and sit with a broker who understands the lending guidelines for income properties and specializes in that space and say, okay, here is what I want to do. Will I be able to refinance it in 3 months once the renovation is done? Yeah. Will I be able to take 80%? Will I be able to get it in a line of credit? Will I be able to get this rate that I thought I would get? Mm-hmm. And in some cases, the answer is yes. And in some cases, the answer is no. And in some cases, the answer is yes, but here is what we need to do. So validating your assumptions is so, so important. That's number 1. Number 2, what we call planning financing. It's one thing, as I mentioned earlier, to get a pre-approval saying, okay, tell me what I qualify for. Okay, Francois, Jennifer, you qualify for $500,000 or $1 million purchase. Okay.
Yeah.
That actually means nothing.
Yes.
Yes, all right.
Oh yeah, we know.
But this pre-approval it just means that someone took your information, plugged in the math to say, okay, your numbers work. Okay, your numbers work. But what you really need to do is you really need to have a more detailed conversation with your mortgage broker to discuss where is the money coming from, show the statements, who will be involved, what type of property, which market are you buying in? Like you have to actually peel that onion and get into all of these details upfront before you go shop. Because it's one thing to go shop for that $500,000 and then come and then we discover there was an issue with down payment, or hey, we didn't think of this issue early on. So you really gotta have that conversation very, very early in the game. So that's number 2. And then number 3 is for investors to look beyond the rate. Okay.
Yeah.
So the rate is really the tip of the iceberg. Okay. You see a lender offering 2.1 versus a lender offering 1.5. And the investor goes, okay, I want to get this 1.5. So here are the things you need to be aware of. Number 1, to get a rate, you have to qualify for the rate.
Yeah, it's always the best posted rate and you don't always qualify for that rate.
Exactly. You have to qualify for the rate. So do we qualify or not? I don't know until I see your numbers. Obviously, we're going to try to get you the best financing package, but the rate alone doesn't mean you can qualify with that lender. It doesn't mean that your deal works with that lender. So that's number one. And then a low rate alone is actually could actually be dangerous, because for investors, you can get a cheaper rate on a 25-year AM mortgage versus a 30-year AM mortgage. But is that the right decision for an investor? Absolutely not.
No.
Right? It's absolutely not. And then all of the fine print. In COVID, guys, we had clients come to us and say, I am on a variable rate. I want to refinance my mortgage because now I'm concerned about losing my job and I just want to have a cushion in the bank.
Mhm.
We look at the mortgage contract. It's a variable rate, but it's fully closed. They can't exit this at all unless they do the refinance with that lender. And guess what? They didn't qualify with that lender. So they couldn't break it and they couldn't qualify with that lender. So they were stuck. But what was this contract about? This was the lowest rate that offered to the client.
They got hooked.
Exactly. So it's the tip of the iceberg. And this is really a very big lesson for investors. It's not all about the rate.
Yeah, and we're really learning. We're starting to invest in the US as well. And mortgages work very differently over there. Like the 5-year firm is really firm out there. Like you're stuck. You don't do like in Canada, all these refinancing. And I think in Canada, it's coming a bit more, like it's getting a bit tougher. I find some loans are more closed from what I've heard anyway. And
yeah, you always have to.
Sorry?
You always have to read the fine print, and that's also the role of the broker to inform you as a client to say, okay, if we go this route, here are the pros and cons, and if we go this route, you need to be aware of the following. I like financing as a package. I like a reasonable rate, a great product, and flexibility with payments combined with, a service for the client. Like I like a package versus just one.
Yeah. Yeah.
And I think that, like you said, that's such a good point, that it's not always the interest rate that's the most important, because what is your plan or your strategy? Is it a BRRRR? Is it a buy and hold? Are you going to keep the property for a long time, or you're going to keep it for 5 years and then sell it? So I think that it's a good thing to know that I think that a lot of times we kind of thought more about the rate and didn't think about the other things, and we're like, oh, schnook.
Yeah, when we go to sell the place, we're like, oh, well, that nice rate was not so great. That
nice rate cost us $20,000.
Yeah. And you can't, your accountant will tell you, ask your accountant, but you can't amortize that $20,000 loss very much. And even if you have a corporation, a loss is a loss. Some years, you do want losses, but not every year.
No.
Exactly. Very important.
Yeah, those are great tips for people that are starting out, and even for people that are maybe progressing with their portfolio. And that's one thing that I liked about working with Streetwise is I like calling your guys and saying, like, that was part of our strategy before François quit his job in November. We called up Kelly and we're like, okay, can we buy another place before he quits his job?
And she was very frank. She's like,
yeah, okay, she
said yes.
Yes, but I like how you said that. But here's what you have to do. And then she gave us the list.
And I'm like, nope, I'm not doing it. Too bad. Bye.
It's the but.
It was the but.
She's like, yes, but you have to wait a month and you have to do this and do that. And it was very structured and really good. And
it was perfect for us to really be able to analyze, okay, are we going to wait and buy another deal, or as far as we're going to still quit his job? And he still quit his job because we just had too much stuff going on.
Yeah, it's like, I'm starting to pay people to help me out and then go to work, and it just didn't make sense anymore financially to work, which sounds weird.
But it was good to know, like, could we refinance? Could we do another deal? Like, it was really good to know exactly what was left.
Yeah, and that's because we kept really close with her, and we always spoke with Kelly, and here's the next deal and the next deal, and she knew everything, the whole portfolio. So yeah,
she knew everything that we had already done, so it was very easy for her to come up with
some potential. I know, just like you said, that was a verbal, so we knew it's not like hard as cash. Like, we're not Doesn't mean we're approved, but it gave us a good idea because I knew, okay, well, if we shop, here's what to expect, and that's it. So that's why I tell everybody work with a brokerage firm.
She always made it work.
Yeah,
we always find ways.
Yeah.
We always find ways. We've never ever had a deal fall apart.
Oh, wow.
In 10 years. And we're very proud to say that. We've never had a deal fall apart.
Amazing.
Oh, wow.
So
that's really good, because I think we've heard about a few people having deals fall apart, and that's I think that the financing, if you're working with a good broker, it's important, because for me, it's the most stressful part of the deal.
Yeah,
it's not the building. Well, the property management comes second now.
Do you guys see all of the gray hair, or no? You don't see the
No, it looks great.
I can't see any gray hair.
Yes.
But I find it is a big stress, because there are so many working parts, like you said, and there's so many parts to the qualification, and then the property, and then getting the funds all together. So it's stressful. And I think that if you're working with a good broker, then it kind of alleviates some of that stress, so that we don't have any gray hair. No.
Yeah. And then the lawyer too, sometimes there's surprises. So everything's great with the mortgage, everything. And then poof, the previous owner didn't disclose whatever. And then there's $4,000 you have to figure out on the closing date. Well, not 4, but more like 10 or so you need cash always. Yeah.
Yeah. There are always learnings with real estate. Right?
Oh, yes. And we've learned something with every deal.
Oh, yeah.
It's always the case. And this is why I say, when we work with clients, we always learn something from every client. We always do. Because every client has their way of doing things, investing in different things, and it's fascinating that way.
Different markets. You touched on a key point earlier. You mentioned approval, but working in tertiary markets and secondary markets, you don't get the same lenders. We still own some properties in Cornwall, and some banks don't want to go there.
Yes.
Even insurance. So you get the deal approved, finance, but then you can't. Well, it's harder to insure. It costs a fortune. So there's a lot of things to consider before choosing a market. Even cash flow. Okay, it cash flows nicely, but no one wants to finance it. So that's not a great deal.
Yeah, exactly. That's exactly it. And this is why this early conversation about what are you going to invest in, where are you going to invest in, what is your strategy, and then all other details related to what the lenders are going to look for is so important to tackle upfront.
Yeah.
You can save yourself the time and cost if you know everything upfront.
Yeah.
Versus, okay, let's get the approval going, and then you have a deal, and then, oh, sorry, the lenders are not going to do this. Now you need to put 35% down versus a 20% down, which you didn't plan for. You don't want to be in situations like that.
No, you never want to ask. That's something I learned. You never want to apply. And I think that came from you and someone else. But anyway, you never ask for money when you need it.
Yes.
You always look for money way before you need it.
Yes. When you don't need it, this is when you line up your capital.
Yeah. Get all the lines of credits and all that stuff when there's nothing urgent. I'll take your time.
Because otherwise you're going to be pulling out your hair.
Yes.
Exactly.
So what do you find is the biggest challenge in your line of work? What is the hardest part about it? Working with unorganized investors?
Well, working with investors is challenging, and it is something that fuels us. It's not something that discourages us. I love working with investors because they get my brains going, and the
challenge.
And we see so much variety in the deals. It's actually exciting. Okay, believe it or not. I know this may sound like
sounds like torture,
nerdy or something, but I mean it. And this is why I love working with investors. But the challenge in our industry is that the rules, we have to always be on top of the rules. Okay, like the rules change sometimes so often, and
every few months.
Just to give you an idea, okay, there are like 150 lenders on the street. Okay, we have to filter out who we want to work with, which ones out of that universe we consider investor friendly, And then we have to know the rules inside out all the time.
And they change.
Each lender has this long of a list on rental properties. Okay.
Wow.
Yeah. So we're always training. We're always keeping track. So it's like if I am to take the lending rules for rental properties and put them on a piece of paper, I think I would cover this back wall behind me. I'm not kidding, guys.
Oh man.
And that's the challenge. We always have to be on the pulse and learn the rules, because if we don't, you can miss one detail that would switch a deal from an A deal to a B deal.
Yeah.
Oh wow. You must be paying somebody full time to do that.
Know the rules. Whisper it in my ear.
We have processes in place by now where we're always on top of these rules and we're always training. So one of the things I tell my advisors and myself is, you really want to be able to look at a deal and go,
nope.
Where it's gonna go. This is where it's gonna go. This is the level of knowledge we aspire to get to in Streetwise Mortgages, for our advisors to be like on the pulse all the time, see a deal quickly and say, okay, this is where it's like a surgeon, like a doctor, right? The doctor can tell them the symptoms without having to go through all of the analysis. They will have a feel with experience of what do you have, what you think you have, right? Further analysis. So that's really our approach to how we want to get to know the rental rules.
That's cool. Great.
Yeah,
that's a good service to offer to investors, because it's so important. Like you said, it could be the difference between the A lender and the B lender.
Oh, yeah.
Or
that's probably why you do all this education too, to try and educate investors so they come a bit more
somewhat prepared.
Or you hope anyway.
That's right. It's not about the investors being prepared. It's really because we believe in sharing knowledge and adding value, and it's good for you as an investor to understand what's involved in running your business. So the more you learn, and we want to be part of your learning. So that's why we do a lot of talks or podcasts or writing.
Yes, and when you're starting out, like, you don't know, can I buy 2 properties? Can I buy 4? Can I buy 10?
Yeah.
Yes.
The more you learn about it, the better position you are.
So on that note, Jennifer, we have investors who have 40, 50 properties and more.
Wow.
Okay. And here's what I can tell you. Can I get you financing? The answer is yes. The answer is yes.
Do you want it?
Sorry?
Do you want that financing? Maybe not.
Exactly. So can I get you financing? The answer is yes, all the time. The question is, what is the cost of financing, right?
Okay.
The question is not whether it's doable or not. The question is the cost of financing. So our role in portfolio financing is to make sure that we are squeezing as much as we can as you grow out of the lenders that will give you the best financing possible, which is 20% down, 30-year AM, low rates, before we go to the lenders that will ask for 25 down, or charge a higher rate or cut down your amortization. And before we go to the lenders who will charge a lender fee. So we're always trying to squeeze as much as we can out of the cost-efficient lenders before we go to the next tier, before we go to the
squeeze it.
Exactly. So that's portfolio financing, because at any point in time, I can finance a deal here with a private lender, but I don't want to do that. I want to figure out how I can bring it down to here and stretch this as far as I can before I can take it to the next level. So we do have investors who have with A lenders, 12 properties before we go to the B lenders and get more. And then we start to look at things like, commercial to continue to squeeze. So it is a process. It is not just a random allocation of deals to just get you an approval.
No.
Yeah, that's so important.
No, it's amazing. I love the story you shared with Sarah Larby and her portfolio, and now I collaborate with her. But you said something really nice on it too on her podcast. Is not, you don't need 1 million properties. Like, she doesn't have 1 million properties or 1 million doors. It's like it's a number. How many do you want or need? And maybe you don't need 200 doors, and that could be enough. So it's
I don't want 200 doors. That would be a headache.
Yeah, that's it. That's what we're thinking about, Jennifer and I too. The other day, we're like, she told me, "Do you realize we don't have to buy?" So I'm like, yeah, that changes everything. We don't need to buy. So.
Yeah, see, this is a really crucial point. Let me share with you a story. I had an investor approach me. Very well-established investor. He approached me. He said, Dalia, I've been investing in real estate for very long. Here is my portfolio. I open up his portfolio sheet, and he has, I think he had 30-something properties, okay? 30-something.
Wow.
And on 30-something properties, he was cash flowing, but he wouldn't be, like, his gross rental income was 200 and something. And then his net income after all expenses was much, much, much smaller. So he came to me and he said, okay, I have this big portfolio. I'm cash flowing, but it is taking so much time because of maintaining it. And yes, I have property managers. How can I optimize it? Okay, how can I optimize it? So I looked at the portfolio, and sometimes investors just think, okay, I want to buy a property, buy a property, buy a property, buy a property, buy a property. Let's buy a property, let's buy a property, let's buy a property. And then, which
you too sometimes.
No, I'm not against buying properties, guys, and this is awesome, and properties are going to create wealth. But at some point, you have to say, okay,
smart properties.
How can I optimize what I have? In this investor's case, for example, we had to say, you know what? If you were to sell this and take this money, dump it against this mortgage, you're going to burn this mortgage, you're going to get your cash flow significantly up. Let's put a line of credit on the property, so when you burn the mortgage, this money doesn't disappear. You can recycle it and reuse it again in something else, like maybe private lending. All I'm trying to say is, it is not the number of properties that determine whether or not you're going to reach your goal. It is it's what's beneath the iceberg. How is financing structured? Is it optimal, or is it crazy leveraged, high expensive money?
Yeah.
And then at some point we need to talk about debt retirement.
Yes, because at one point, yeah, you have to pay it.
Like, okay, we're going to acquire. We all want to go through this acquisition phase.
Yeah.
But at some point, we have to talk about debt retirement. What are we going to do to actually bring all of this?
You don't give it to your kids with the mortgage.
Exactly. Your kids would be laughing by the time you take the portfolio. It's all paid off and they're enjoying themselves.
Wow.
but for you, what are we going to do to retire the debt? And it's not something complicated. Maybe we sell certain things and burn certain things. Maybe we do lump sum payments. Maybe we just utilize prepayment privileges. But that has to be part of the thinking to actually bring it all home. And that's what works. I've seen so many portfolios. I've seen large portfolios, and people would go say, oh, I own 200 properties. Okay, and great.
My cost.
but I look at the portfolio, very highly leveraged, very expensive money, versus taking so much time, versus someone who has maybe 10, 15 properties, and they are cash flowing beautifully. They're,
able to sleep at night.
Lean. It's like having the masculine guy, at the gym, and the lean body. Okay.
Yeah.
What kind of portfolio do you want to build? Again, I am not against numbers. All I'm saying is that debt retirement has to be part of the thinking.
Yeah.
That's such a good point, because I think that a lot of times you do get all wrapped up in it, and you get another property, and you're not really thinking at the end game, how are we going to end the game?
At some point, we're going to retire. And
yes.
Like a true retirement.
For real.
Not just a job, everything.
Yes.
Yeah. So on that note in particular, we have these discussions early with investors. What is your ultimate goal here? Okay. And how many properties do you really need? yes, we can incorporate joint ventures. Yes, we can buy multi. Maybe we can do BRRRR. But what income are we after, and how are we going to bring this income home? Actually, at some point, this is something we're actively working on right now. I have now a financial planner on my team.
Nice. That's
wow.
nice.
I have a financial planner on my team who would help investors incorporate their investment plans, real estate investment plans, with the overall financial picture.
Yeah,
to get that clarity.
Yeah.
To get that clarity.
Wow, that's an amazing service I didn't know about. So it's good you came on.
Yeah, it hasn't launched publicly yet, but we are so close to.
It kind of has now. You mentioned it.
Yes, I know.
On right now, but we'll have more.
It's coming. So, and it is driven by exactly this reason. Clients want to know what's the end game.
Yeah.
And they want to see what the end game is.
Yeah, because you don't really have many people who are talking about the financial part like towards the end. Like I think that a lot of people are just all in the beginning, like an acquisition,
middle, and then poof, they disappear. You don't know what happened.
Yeah, there are aspects to there are aspects to real estate investing, as you guys know. I mean, at the end of the day, we're all building this for generational wealth and cash flow. Okay, but things like, okay, how are you going to bring this cash flow home? How many properties do you need to actually retire or to replace your income? Mm-hmm. Which markets are you going to invest in? What if the people on title die?
Yeah, what happens then?
What happens to the real estate assets? Are you going to pay the government like taxes on the estates, and now
now you lost it?
Yeah, and what happens if someone gets disabled? These are things that are not talked about. There is talk about, let me buy the first and the second and the third and the fourth and the fifth, and like I want to keep going. But what about all of these other things that are part of life that we have to think about so that we can have a solid portfolio at the end of the day?
Mm-hmm. Yeah, that serves you. Important. You don't become a slave to your portfolio. You're actually, it serves you. So wow,
that's great. So you said earlier, Dalia, that the rules are always changing. What do you see kind of happening in 2021? Like we're kind of early on in the year.
What's next?
What's next?
So when COVID hit, everybody tightened the belts, and we've seen that on the residential side and on the commercial side. I would say on the commercial side, there are still restrictions, or the lending appetite is tight when it comes to pure commercial units. So business, retail, exactly. And it's not a surprise, right? We know that businesses are closing. We know where the hit has been, unfortunately. So of course the lenders are very cautious about lending to retail spaces and office spaces. So that's still tight. And then also we've seen CMHC tighten their guidelines when it comes to equity takeouts on apartment buildings. I don't think that's going to change anytime soon. On the residential side, we've seen lenders during COVID, again, take a backseat to observe what's happening in the market. So we've seen Scotiabank stopped approving the use of line of credits.
Yeah, that's right.
Yeah, so you couldn't use a line of credit for down payment on a rental property, but that has changed. That's now back to normal.
Yeah, they've gone back, but I understand why they did it. I mean, you didn't know where things were going, so that was a smart move.
Yeah, they didn't want leverage on top of leverage, right? Because there was a concern at some point that the real estate prices may soften. So if a lender has leverage on top of leverage, now their value.
2008 in the United States.
Exactly. And I love the Canadian lending system. It is, as much as we sometimes say, oh, it's getting tighter and we want it to be aggressive. It is really what's protecting the economy, and it's protecting investors. So Scotiabank has come back, and then we've seen lenders limit lending to investors who are relying on rental income 100%. So if you have an investor who's just living off rental income, we all know that at some point there was a lot of talk about tenants not buying and not paying, delayed rent payments. So that was a no-no at the beginning of the pandemic. We're starting to see it ease up again. So I don't think the lenders are going to loosen up in 2021, but I'm happy to see that things have stabilized since 2020 on the residential side. So that will continue. There's like interest rates are going to stay low. Variable rates are going to stay low for at least another 2 years. Bank of Canada said that they're not going to raise prime until the economy absorbs the shock and from the pandemic, which is going to be likely around 2023. So rates are going to stay low. Fixed rates also at historical lows. They may increase slightly, but they will still remain low. So great interest rate environment. Lending guidelines on the residential side, I would say, are reasonable. They're not crazy tight or anything. Commercial is a little bit different depending on what you're buying. But I think the real estate activity for properties below the $700,000 mark is going to remain crazy.
Because,
yes.
As you guys know now, I saw this article that said there was about 50,000 people that left Toronto and moved outside of Toronto, right? Yeah. People are working from a distance, and of course they're looking for affordability wherever they go. So 700 and below is a hot market for those who are looking to relocate, and of course for investors who are looking for cash flow. So I think it's still going to be a crazy year in terms of inventory and also competitive offers and pressure.
Yeah. We've already seen it.
Yeah, we've seen it.
For sure.
Yeah, just insane.
So, well, thank you so much for talking with us, Dalia. If somebody wants to get a hold of you and your team, how can they do that?
It's simple. They can go to streetwisemortgages.com and fill in our contact form, or they can email us at info@streetwisemortgages.com, and I will get that email, and my team also will get that email.
Oh, yeah, that's great.
You have a great team. There's Kelly. I know there's Tia. Who else? Madison. Who else is on your team? You have Rich, I think, now on the private lending.
Yes, that's right. And then I have Elena and Andrew. And then we've got the support team.
So. Nice. So nice, well-rounded team, and even mother-daughter, I think, Kelly and her daughter.
Yes, Madison. Yes, exactly. Madison and Kelly are mother and daughter team.
Oh, awesome.
So Kelly is an advisor and Madison is on the support side.
That's awesome. We have a question, or actually, thank you. So Charlie's saying, thank you, Mrs. Barsoum, for your time and knowledge. I agree with a lot of the info you provided.
My pleasure.
Good luck in 2021 to you and your team. Yes.
Thank you. Thank you very much. I appreciate it.
Yeah, and Mike said really thought-provoking ideas, which is so true. I think that you're going to make us rethink some of our strategies.
Yeah, it's not the number of doors. It's more the efficiency and the planning and the end game. Yeah. Yeah, do you want that bodybuilder or lean body? I'm going to go with the lean. It's less maintenance. I can still drink some wine. So.
No, yeah, we can give away the wine, guys.
No, we only live once.
Actually, red wine, talking about wine, red wine is good for your health, as far as I know.
There you go. It is. I have a glass every day. It's great for your health.
We have in our kitchen, this is really bad. We buy these huge boxes, Magnota Wineries, up your way in Vaughan. And there's a tap, so you put it up on the shelf and you just go by your tap and refill your glass.
Oh, okay.
And there's Shiraz, so this is a Shiraz from
Cabernet Shiraz.
Cabernet Shiraz.
It's actually really good. Like you think that the box wine is not good, but this one is actually very good.
And it lasts for 6 months, but not here.
No, it does not last for 6 months.
I gotta get the name from you. I gotta get the name from you guys. I know some of the Shiraz mixes are nice.
Yeah.
I've had a few before, but if you're saying the one you're drinking is nice, text me the name.
Yes, absolutely.
I will. Thank you so much. Have a great evening, and we'll stay in touch while we are communicating on other deals.
Yeah, we're working on a deal right now with Dalia.
Live.
It's slow but sure, but I think that's kind of the commercial side of things. It's slow but sure.
Yes, yeah. I should have an update for you guys on that one soon.
And it's off market, so we're not too bad.
We're not in a huge hurry.
And the pandemic is in our favor right now because where it's located, things are slower. So Let's take advantage of it.
Yeah, no, that's great. Anything off market, obviously, you have the luxury on your side. Anything that is going on MLS right now is
insane.
Yeah. No.
Insane. Yes.
Yes.
Thank you so much.
Thank you very much for this opportunity, guys. I enjoyed our conversation, and cheers.
Yes.
Cheers. Salut.
Bye.
Bye.
Bye-bye.